Hey everyone, welcome back to our channel where we help you navigate the world of finance and investing. As we look back on 2022, it's safe to say that it was a rough year for the stock market. The S&P 500 dropped 19.4% even after accounting for dividends, while the tech-heavy Nasdaq Composite took a staggering 33.1% hit. A number of factors were at play, including inflation, interest rates, recession fears, and geopolitical tensions. However, this also presented an opportunity for savvy investors to pick up great companies at discounted prices as the year came to a close. As we gear up for 2023, we're excited to share with you our top 6 stock picks for the year ahead. We'll be taking a look at each of these stocks and how they performed so far based on their total returns, which include dividends. So sit back, grab a cup of coffee, and let's dive into the top 6 stocks to buy for 2023. Number 1. Let's kick off our list with the tech titan, Apple. Despite being the world's largest publicly traded company excluding government-backed giants, 2022 was a tough year for AAPO shares, as investors in the tech sector were hit hard by recession concerns and skyrocketing interest rates. However, following a significant 26.4% dip, Apple stock now trades at 25 times earnings, providing investors with a solid entry point into this $2.4 trillion iPhone behemoth. Despite falling slightly short of earnings expectations in its most recent report, Apple's demand remains strong, with over 2 billion active devices and services revenue exceeding $20 billion. And with AAPL shares bouncing back from their 2022 woes, with a 16.1% gain since the start of 2023, it's clear that Apple remains a force to be reckoned with in the tech world. So, should you buy AAPL stock? Let's keep exploring our list to find out. Number 2. We all know that big names like Apple can provide a solid foundation for investors, but what about smaller, up-and-coming companies? Well, Dutch Bros is one such example that's well worth considering. Although Dutch Bros is a mere fraction of Apple's size, with a value exceeding $6 billion, this rapidly expanding coffee chain has some serious potential for growth. Revenue is booming, with a 53% year-over-year increase in the most recent quarter alone. While Dutch Bros got its start on the West Coast, the majority of its 671 locations are concentrated in the West and Southwest. But with its drive-through model, opening new location is a breeze and significantly less expensive, allowing for faster expansion. That's evidenced by the fact that Dutch Bros opened 133 new stores in 2022, equating to a location growth rate of 25%. Investors have been taking notice of this coffee chain's potential, with Bros being the top performing stock among our top 6 picks for 2023. With shares already up 30% through this year, it's clear that Dutch Bros is a company to watch in the coming year. Number 3. Now let's talk about Citigroup, a massive multinational bank with retail and investment banking divisions, worth about $100 billion. When it comes to what this company can offer investors, there are 2 key things to consider. First and foremost, Citigroup provides a healthy 4% dividend yield, which is a significant advantage for shareholders during a time of rising rates and inflation. The bank's dividend is also sustainable over time, with less than 30% of earnings used to fund payouts. But Citigroup isn't just attractive for its dividend. At current levels, the stock also looks like a value pick, trading for less than 8 times forward earnings and just 0.54 times book value. It's not just us who think so either, as legendary investor Warren Buffett has taken notice. Number 4. In the world of e-commerce, Amazon needs no introduction. It's a massive company with a massive impact, generating over $400 billion in sales in 2022 alone. But the stock market hasn't been kind to Amazon recently, with the company's shares dropping 50% in value. However, there's a bright spot in Amazon's portfolio: Amazon Web Services, AWS. This cloud computing platform has become a force to be reckoned with, raking in over $85 billion in annual revenue. In fact, if you value AWS based on the same metric as Microsoft's cloud service, it's worth over $850 billion. That means that the rest of Amazon's operations, which are nothing to sneeze at, are essentially being valued at $150 billion. So, while Amazon's 2022 may have been rocky, it's clear that the company is still a heavyweight in the world of tech, and investors who have faith in AWS are likely to reap the rewards. Number 5. When it comes to investing in stocks, one of the most crucial factors to consider is the company's management team. And in that regard, Disney is a clear winner with its recent reappointment of legendary CEO Bob Iger. Widely regarded as one of the most successful CEOs in recent times, Iger oversaw a string of massive acquisitions, including Pixar, Marvel, and Lucasfilm, before stepping down in 2020. In the first earnings report since his return, Disney smashed annual estimates, reporting strong revenue and earnings figures. Despite raising prices on its Disney Plus streaming service, the company lost fewer subscribers than expected and saw a whopping 21% increase in revenue from its theme parks. With Iger's magic touch at the helm, Disney shares have already jumped 27% this year, making it an attractive pick for long-term investors looking for a stable and well-managed company. Number 6. In the world of finance, PayPal is a well-established stock that has proven its worth time and time again. Despite its earnings per share of $4.13 in 2022, which was higher than any year between 2018 and 2020, its shares took a massive hit in 2022, plummeting 62%. But here's the good news. PayPal is now trading for less than its pre-pandemic levels, and its shares are priced at only about 20 times expected 2023 earnings. This is quite low when you consider that its 5-year average price-earnings ratio was 36.5. In fact, the company's lowest P ratio between 2015 and 2021 was 20.3. In addition, PayPal's recent partnership with Apple Pay to accept PayPal and Venmo branded cards will increase its presence in physical stores. And Amazon now accepting Venmo gives PayPal exposure to its massive online marketplace. With all these factors in play, PYPO stock is up by 10.1% in 2023. Hey there, thanks for watching our video. We hope you enjoyed it and learned something new about the stock market and the top 6 stocks to buy in 2023. If you found this video helpful, please give it a thumbs up and consider sharing it with your friends and family. Sharing is caring, and who knows, this video might help someone you know to make informed investment decisions. Also, make sure to hit that subscribe button and turn on notifications so you never miss an update from us. We're always posting new content about the latest market trends, investment strategies, and expert insights, so don't miss out. Thank you for your support and for being part of our community. We appreciate you and look forward to seeing you in our next video.